Morning, everybody. It's Louis here. Happy Father's Day to everyone out there. Here currently in Calgary right now for the next week or so. And today I just wanted to share three quick tips on becoming a successful stock trader. I really challenge everyone to try to take their finances into their own hands. I think that nowadays there's so many fantastic tools out there on the internet that you could do better than the 5 or 6% that mutual funds get you. I think that it's important that everyone learns more about investing, learns more about finances, learns more about economics because it affects all of us. And if you get heavy into it and you do well, it could change your life. And the best part of it is that, at least for myself, is that I like being a digital nomad, and I like being able to live anywhere in the world as long as that there's Wi-Fi. I know that I can make money. I understand that not everyone could have this type of lifestyle. If you have wife, kids, it's not very easy, but you could still do well for yourself and maybe make enough in the stock market that you could put your kids through college or put a down payment for a house, whatever it is, whatever your financial goals are. Everybody's different, but I just want to try to help out others and share some of my experiences and also some of my tips that I think have made me a successful stock trader the last 5 years. So the first one I want to start off with is so there's three main components I believe in being a successful stock trader. That is number one, research. You know, uh, Sedar is a great website that I would recommend to everyone. SEDAR, and that is pretty much where you're going to find all the news releases, all the financial statements for every company. It's regulated through the exchanges that these stock companies have to um, uh, release news releases when there's changes in the companies. So go on there, get familiar with the website. Go back and read 10, maybe 15 of their company's last news releases or financial statements, so you kind of get an idea where the company is at. And you could also see, you know, their last private placement, for example. This is very key because when a company does a raise, a private raise, and usually there's a 4 month hold on these raises that the shares are locked in and you can't sell. But once those shares become free trading, and if the stock has, doubled, quadrupled, whatever it's done, I mean, it's human nature that you're going to want to take profits. So say there's a company has a 90 million share float, and you're going to have 10, 15 million shares coming unlocked July 15th, then there's going to be a very, very good chance that there's going to be down selling pressure, which is going to cause the SP, the stock price, to go down. And so you want to be aware of that because you don't want to be buying shares a week or two before that happens, and then you're going to be, you could have gotten in a lot better entry point if you would have waited and if you would have known that. So, research. Read articles that have been released by different news outlets on the company. Read social media has a lot of great groups. When I started in the cannabis space, I joined every cannabis Facebook group I could, and then you befriend other, stock traders, and you become acquaintances with them, and you learn from them, or they learn from you, and there's really nice communities out there for people that want to become investors and traders nowadays. I mean, there's also a lot of bullshit out there, so you got to be careful. A lot of scam artists and stuff, but you know. That's something I really recommend is doing proper research because you have to know the skeleton of the stock, if you will, so you know what's going to happen when just so you have a better understanding of the company. Another thing, is fundamental analysis. Learn how to read financial statements. What's the difference between a balance sheet? What's the difference between a cash flow statement? What's the difference between an income statement? You know what I mean? So all these things are very vital, because you can look at financial statements and you can look at the health of a company. So for example, you read the last quarter's financial statements, and you're seeing that this company is burning, for example, $1 million per quarter. So they're losing $1 million per quarter, and they only have 3 million, in 3 million, they're only sitting on 3 million cash. Well, that unless this company starts generating revenue, and a lot of these startups, it takes some years to start generating revenue, that this company is going to have to do another private raise, or they're going to be fucked, after 3 quarters. So financial statements are very key, and fundamental analysis is very important in learning about the health of a company. And number 3 is another thing I want to mention is technical analysis. Technical analysis is very important, especially for swing traders and day traders, because you should learn, resistance and support levels, learn how to draw trend lines, learn different chart patterns, what's a cup and handle, what's bullish flag, what's bearish pennant. All these things are tools to add to your tool chest. So you're kind of like a carpenter. The more you learn, the more you educate yourself, the more tools you have at your disposal, so you can make better educated investments. Learning about candlesticks, what's an inside what's an inside candle? What does that mean? What's a doji candlestick? Learn about how to read candlesticks can tell you a lot. You know what I mean? And then you also have the different time frames. Are you looking at 1 minute time frame, 5 minute time frame, 50-minute time frame as a day trader, or are you looking more daily and weeklies? So I would recommend a top-down approach. So when you're starting out, I would start off with the weekly charts, and then the daily charts, and then go into the hourlies, and then you can break it down into half hour or 15 minutes and even 5-minute charts as well. But you always want to start off at the top, so you kind of have an overall focal point of how you're analyzing the stock. How's it been doing the last 6 months, and then 3 months, and then the last few weeks, and then daily. So I would really recommend a top-down approach when you're analyzing technical analysis for companies. Another thing I want to really, especially if you're going to be an active day trader or a swing trader, is do a proper pre-market analysis. So wake up an hour earlier before the market opens, or an hour and a half or 2 hours, and you look at how did the Asian markets do, because Asia is obviously ahead of us. It doesn't always correlate, but there's certain correlations between the different markets around the world. Was there a huge geopolitical news over the weekend? All these things you have to take into consideration, because they affect the stock markets in North America as well. So, take a look at the Asian markets. Take a look at the futures, how they did early morning, and then you want to start reading news releases of whichever sector you're invested in, or whichever stocks you're invested in. Was there any positive news releases? Was there any negative news releases? And then start going through charts. You know what I mean? One thing you want to take into consideration is volume. If you don't have, think of it as an audience. You know what I mean? If you have no audience, you're not going to move up or down. And as a trader, especially if you know how to short, and you know about options, then you want volatility up, up or down. You can make money if you know what you're doing, but you have to do the research beforehand, so then you can make proper decisions when the market opens. And another important thing too is have a game plan. This is very important. Have a fucking game plan. Don't you're going to have an idea of what you want the stock to do, but what if the stock doesn't do what you wanted it to do? So, for example, let's say the stock goes down. Like, what are you comfortable with losing, or are you just going to bag hold? So, like, say the stock opens and you're within the first couple hours, are you down 10%? What are you going to do? Are you going to buy more? Are you going to hold? Are you going to sell? And you know what? If you let's say you can only trade an hour or two in the mornings before you have to go to work or something like that, then you want to set stop losses. A stop loss is preset so that, say, you're down 10%. Let's say a stock is $1 and it's down at 90 cents, so you're down 10%. Then you can set a stop loss before you go to work, and those shares will automatically sell once it hits 90 cents. So stop losses are very important to decrease the amount of money you can lose. And the third thing I want to go over is the psychology of trading. This is very important because the stock market is driven by two factors: fear and greed. And actually, fear, believe it or not, is actually stronger than greed. So when people get scared, and amateur investors or people that are new, they see their stock down 20, sometimes 30%, especially in penny stocks. Penny stocks are very, very volatile. You can make a lot of money, but you can also, your stocks can go down quite a bit pretty quickly. Like, a stock can easily go down 46% in the matter of 2 or 3 trading days. That's not unheard of. Obviously, blue chips don't work like that, but assess your risk levels as well, right? Like, do you feel comfortable investing in penny stocks, or do you want to stick to the S&P 500 blue chip stocks, which are going to give you maybe a return, of 2 or 3%, in say 3 or 4 trading days or something like that, and like you're comfortable with that because those stocks aren't going to have that huge volatility. So. But I would definitely say that, the learning is, like, if you do a proper analysis of a company and you feel comfortable with it, then you shouldn't worry if the stock is down 10 or 15%, maybe even 20%, because you did your analysis. You're comfortable with it. There's nothing in the underlying stock that has changed. It might have got some. The industry might have had like a bad news release or something like that would have made the stock go down, or the stock has been on such a bullish run. Then not every stock is going to continue going up and up and up and up. Healthy consolidation is perfectly normal. And also, I want to say, don't have FOMO, fear of missing out. FOMO is very real, and people chase a lot, especially new investors that. They're like, oh my God, that stock is up, 38% in the last couple trading days. I think it's going to continue going up and up. So then you get into it at a very bad time, and then you start seeing people take profits, and then the stock starts going down, and then now you have to wait for a stock works in 4 cycles, and so now you're going to have to wait until it goes into a bullish run again. So. The psychology is something that is not talked about enough. Another thing too is learn how to scale in and out of trades. And what I mean by that is, like, no one knows exactly what the stock's going to do, because it doesn't matter how good of a trader you are. If people knew what the stock was going to do, each and every time, then there'd be a lot of multi-millionaires and then possibly billionaires. But we never know, right? So you want to try to reduce your risk, but also make profits. And so I recommend scaling in and out of trades a lot. So scaling in is like say split it up into thirds or quarters. So, like, you're going to make an investment. Say you got $4,000. Okay, you're going to make an investment here of $1,000 or $1,500. Okay, you're going to see how the market reacts after that, and give it maybe a couple hours or a couple days, and then you're going to scale into another $1,000 or $1,500 into that trade, and you're going to average up or down, and then you're going to wait a little bit longer, and then you might scale in, and then you might use up the rest, to buy up more shares, and also scaling out. So, say you're up 15%, you have 100,000 shares, well, you know, you want to take some profits. You know, you don't have to sell all of them. You know, all your whole float of 100,000 shares. Say sell 35,000, or say sell 50,000 shares. So that means you lock in profits. Always lock in profits. You know, pay yourself. You know what I mean? You don't want to be that idiot that like the stock was up 15-20% and you were greedy and you thought it was going to continue going up another 10-15% and you didn't sell, and then the stock ended up going down, and then now you didn't take any profits, and now you're like, oh shit, like, you know. So take profits, pay yourself. So to recap again, guys, number one is, you know, the three areas, the three components. Be strong in the three components, which is research, technical, and fundamental analysis. And then number two is be prepared. Have a game plan every day when you're going to trade. Do a proper pre-market analysis, and either way, going bullish or bearish, have a game plan. And number three is psychology. Learn how to scale in and out of trades. Don't be greedy. Don't sell out of fear. Don't get FOMO, fear of missing out, and chase, and then be stuck bag holding the shares that eventually ended up going down because you chased. Anyways, guys, those are three tips to start off with. I'm going to try to be doing more videos on investing and try to help out others. And if you feel that you're getting any value out of this, then hit subscribe on my YouTube channel. Thanks a lot. Enjoy your Sunday.